One. Hello, we are JMJ, and we consist of Metchem, Jesus, and myself, James. In recent trends in market concentration, particularly in the technology sector, have ignited debates about the balance between fostering innovation and mitigating the harms of monopoly power. The rise of tech giants such as Google, Amazon, and Meta have transformed consumer habits, workplace dynamics, investment landscapes, and broader societal structures. While these firms have brought significant benefits, their increasing dominance raises concerns about fairness, competition, and long-term economic health. On the consumer front, dominant firms have undoubtedly delivered value. Companies like Amazon have revolutionized e-commerce, offering lower prices, fast product availability, and convenience. Google and Meta provide free services such as search engines and societal platforms, funded through the advertising revenues. These innovations often stem from economies of scale and technological advancements, benefiting millions of users. However, monopoly power has its downsides. Reduced competition can lead to higher prices, limited innovation, and lower quality over time. For instance, when firms like Amazon dominate the market, smaller competitors are often pushed out, leaving consumers fewer choices. Additionally, data privacy concerns loom large, as technology monopolies exploit their dominance to collect and monetize vast amounts of personal information, often with limited transparency or alternatives for consumers. Workers are another group deeply affected by rising market concentration. Tech giants have created millions of jobs, ranging from warehouse workers to high-paying tech roles. However, these benefits are not evenly distributed. Companies like Amazon wield disproportionate power over their labor forces, depressing wages, limiting benefits, and fostering poor working conditions. Market concentration also weakens workers' bargaining power. When industries consolidate labor market monopsony, where a single employer dominates, can depress wages and limit job mobility. For investors, monopolistic firms often provide high returns. Dominant companies benefit from scale and network effects, translating into substantial profits and stock market performance. However, concentration also poses risk. Over-reliance on a few dominant firms could expose investors to volatility if regulatory pressures increase or if innovation slows. Moreover, excessive concentration in financial markets might discourage capital from flowing to smaller, innovative firms, potentially stifling future economic growth. Monopoly power has broader societal implications, particularly in how it affects democratic institutions and economic inequality. Critics argue that tech firms' influence over information flows can shape public opinion and political outcomes, posing challenges to democratic accountability. Meta, for instance, has faced allegations over amplifying misinformation for profit, contributing to societal polarization. Economic inequality is another consequence. The wealth concentrated in a handful of firms and individuals exacerbates income disparities, particularly when profits disproportionately benefit executives and shareholders at the expense of workers or consumers. This concentration of wealth can erode trust in institutions and foster a social unrest. And now I'll hand it off to Jesus.
Thanks, James. So moving forward with our conversation on do the ends justify the means, antitrust policy in recent years. So the US has a long history of innovation and forward-thinking entrepreneurship, which has derived and created really great and important products that we all benefit from. However, we also have seen that as companies grow and innovate, a lot of them get acquired and they get merged, and as such, we end up looking at a lot of potentially monopolistic players in the market. This has pushed the government towards placing more scrutiny on how and when companies are acquired and how they merge. Nonetheless, can we always necessarily say that this is a positive benefit for society? Next slide. So James has mentioned, and I will echo here some of the reasons for pushing for antitrust policymaking. Wages have been severely decreased in the last handful of years. We've been looking at it as recently as 2000. Studies have shown that an estimated 535 billion less goes to workers since since we've started looking at a lot of these general labor shares. So how many dollars do workers versus corporate individuals take home after a given calendar year? And they've certainly been significantly lower, and they seem to be on the decline. Subsequently, higher markups. Whether a company has the ability to set their own prices also dictates how big of this markups, which is the gap between the marginal cost and the sticker price, have increased significantly. So from 18% in the 1980s to about 67% today. This this higher market concentration that some researchers and economists look at can definitely lead to increased price power. As James also noted, and so we've talked before, as monopolies concentrate, we see the effects in the form of less innovation as well as greater inequality. So through a variety of mechanisms, including the above mentioned, a great chasm exists between the managerial class and the working class in the US. For each dollar of monopoly profits, a total of 37 cents is transferred from the 90% poorest to the 10% richest. Next. While we do benefit from pursuing antitrust policy making, there are severe issues and roadblocks that emerge in this particular field. The biggest one being shifting metrics. So as I alluded earlier, there isn't always a clear way to genuinely define whether a company is engaging in monopoly or monopolistic practices. And some look at market concentration, some look at profit, some look at markups. All of these metrics give you ideas on whether or not a monopoly is emerging. However, it is not always clear to a policymaker or to the government when they're looking at a company in a merger and determining whether or not that is necessarily creating an illegal monopoly. Secondarily, we do live in an ever-changing society. So we've been moving deeply into digital markets, and those have different arrangements, different concerns, different profit-making schemes, and we need to have a policy and a policy-making body that is able to quickly adapt to this new market and to make the actual policies that we implement relevant and applicable. Um, Thirdly, as I mentioned, as metrics change and as they complicate the relationship between the government and monopolies, we also have more nuanced relationships between like things like market concentration and price setting. As such, it's not always necessarily clear that even if a company has, for example, the ability to set up a markup, that they are necessarily engaging in monopoly per se. And so that even complicates the way that we can look at a company that may or may not be running an illegal monopoly. And then fourth, and I think one of the more nuanced issues is that we may have a cultural issue at hand as well. The startup culture is not only concerned in becoming the biggest player, but also a lot of the times being acquired. And so we do need to deal with the fact that even as we see more players, many of them might be actually interested in being acquired by Meta or being acquired by Amazon or Google. So that is something that we should always take into consideration. Next slide. So we will be looking generally at Google today, but I would like to also mention Meta and Amazon. So Amazon has engaged in practices that have been deemed by the government as relatively hostile in terms of price setting and contracting. So they've made it really hard and in some cases impossible for new players to enter into the marketplace business. And as such, they're being investigated for engaging in illegal monopolistic practices. Meta, in a similar but different fashion, through their recent acquisitions of Instagram and WhatsApp, have been brought into questioning in terms of whether they are genuinely engaging in competitive marketing with their competitors like Apple and Google, specifically because of the overpricing of Instagram and WhatsApp as a strategy to foreclose any potential competitors in that space. And lastly, in the bigger case that we were looking at today and the most relevant, because they are currently in court for a really big investigation, is Google. So their search engine monopoly debacle has been found to be monopolistic. the government has determined that their dealings with companies like Apple in terms of determining their search engine as the default feature is actually an illegal anti-competitive practice, and they're still in court to this day because of their ownership of Android and Google, and a subsequent instances where their search engine is also being favored over any other competitor. Next slide. This case generally involves a handful of parts. The biggest one has a lot to do with their search engine. So Google has entered into a variety of contracts with Apple, Amazon, etc., where they have positioned themselves as the default browser. And that makes it hard sometimes for consumers to switch or know that there are different players. And that gives them an incredible advantage, not only in usage, but also in data collected from search, which then rolls and turns into a bigger advantage going forward. As such, the government has taken them to court not only once, but twice. The first time was over this precise search engine issue, which they have been found to be guilty of engaging in monopolistic practices. And this has led us to have to consider the role that then Google can play in owning things like Chrome, which is a web browser, or Android, which is an operating system, and how they also default to search, and how that keeps giving them a great search engine advantage over any competition that would emerge. So as of November 20th of this year, Judge Mehta will hear closing arguments from both sides, and things that are being considered are whether or not Google needs to sell Android and Chrome, whether they need to share data with competitors, and whether they need to divest from AI companies in which they are heavily involved in. Next slide.
Thank you, Jesus. Today, we are examining the argument for against breaking up the Google. A proponent argue that breaking up Google will restore fair competition by opening market to a smaller competitor, increase customer choice by ending restrictive default argument, and promote innovation by giving rival access to Google data. On the other hand, opponents highlight the value of the Google integration ecosystem, which support seamless innovation, the risk of weakening U.S. global tech leadership, and significant legal challenging in implementing structure remedies like diversity goals. Next. One of the key strengths of breaking up Google is reducing entry barriers and supporting more diverse market ecosystem, forcing Google to share its shared data, equip smaller competitor with the tool to innovate and compete fairly. This also promotes entrepreneurship and encourage investment in startup. Historical action like breaking up of AT&T in 1980s show that the monopolies can lead to a competitive and thriving market, setting a precedent for similar action in the big techs. Next. Another strength lies in benefit of customer and competitor. By banning Google default argument with company like Apple, consumer would have unbiased access to alternative search like Bing or DuckDuckGo. This support competition, which can drive down price for advertising and customer facing too. Moreover, opening space for emerging technology to compete would fuel innovation across sectors such as advertising, AI, e-commerce, benefit the broader economics. Next. Breaking up Google presents significant weakness. Scipio is the key challenge, which court historically favoring oversight over structure like diverse teachers, are seen in level of Microsoft breakup. Another one is operational hardware. It separating Chrome, Android, and search could create insignificant and impact the usability of Google integration ecosystem, inconveniencing customer. Next. Breaking up Google risk U.S. tech leadership globally, making it harder to compete with the foreign firm like Tencent, or Alibaba. This could lead to loss of market share or Google's centralized R&D model could slow down innovation, and smaller competition may struggle to meet Google economies of scale, potentially leading to a higher customer cost. Next. In conclusion, market concentrate in U.S. economy provide innovation and convenience, but also raise concern over reduction of competition, lower wages, growing inequality. Antitrust policy are crucial for supporting fair market, but facing significant and practical challenging. Balancing innovation, competition, and regulation is very important for supporting economic growth and long-term sustainability. And this is the end of our presentation. Thank you.